All right, so the first, let's see, I think that should be shared, right? You guys seeing that screen? Okay. Um, so the first concept in this chapter is the idea of adjusting entries, and adjusting entries sometimes break people's brains, and then other times it just seems natural. It's a funny thing how that goes. But really, so the whole purpose behind adjusting entries is to recognize these moments when our cash and our expense, or our cash and our revenue, don't match up with each other perfectly. Okay, because we're doing accrual-based accounting, we need to recognize there may be times when we receive cash, but we haven't yet earned that revenue. So we've got to know how to deal with that. Other times when we earn revenue, but we haven't yet received the cash, and we're not going to get the cash until some future financial period. Likewise, there's times when we pay for an expense, but we haven't actually incurred the expense, so we prepay, maybe for an expense that's coming up later. Or there's other times when we incur the expense, but we haven't yet paid for it, and so we're going to have to pay for it in some future period. So these four types of adjusting entries are really, that's it. They're just these four circumstances where the cash and the revenue, or the cash and the expense, don't match up with each other. And I think sometimes we try to think of it as this big confusing thing, and that's really all that's happening. So I'm going to walk through the four types and give a few examples, or at least one example of each. So the first is what's called a prepaid or a deferred expense. So this is where, again, so we pay for an expense, but we haven't yet incurred the expense. We're going to incur the expense in the future. And so every time we deal with one of these prepaid expenses, we're going to have to, when we initially make that entry, what we're going to do is we're going to debit an asset, usually called prepaid rent or prepaid. That's the most common thing to prepay is rent or insurance. People will pay for insurance way into the future, right? So we're going to debit that asset account and credit our cash when we initially make that transaction. And then at the end of each time period, month or quarter, whatever, however we record our things, we're going to credit the asset to decrease it, and we're going to debit the expense for that amount of the expense we've actually now incurred during that period. So that's what a prepaid expense is. So let me see if we can look at an example. Or actually, let's look at the process. So Fast Forward pays $2,400 to cover insurance for 24 months. This began on December 1st, 2020. So when they do that, they debit prepaid insurance, which is an asset that represents, I guess, insurance services that are owed to us in the future. Okay. And then our second step is at the end of the financial period, we have to make this an adjustment. So if it's $2,400 for 2 years, we could divide that by 24 months and realize that this represents an insurance expense of $100 a month to be spread out monthly over the next 2 years. So then each month, we're going to do an adjusting entry where we debit insurance expense and we credit prepaid insurance. At the end of 24 months of doing this, our prepaid insurance account will be down to zero, and we'll have claimed the full expense of that insurance at $100 a month. You can see how this makes sense. If we take this whole expense in one big chunk, like when we first pay for it, then it's not going to really match up with our revenues, because this isn't really $2,400 in a single expense. It's actually $100 per month over 2 years. So that's why we do these adjusting entries. So there, our balance at the end of 1 month after we do our first adjustment will be $2,300 in the prepaid insurance account. And we'll have claimed an insurance expense of $100. All right. I think so. That's what the journal entry would look like there. A debit to insurance expense for the adjusting entry of 100, and a credit to prepaid insurance. And so adjusting entries for these prepaid assets always look the same way. The adjusting entry is always a debit to the expense and a credit to the prepaid, prepaid asset, whether it's prepaid insurance or prepaid rent or whatever. They always follow that same pattern. Supplies kind of work the same way, in that when we purchase supplies, our supplies asset goes up, and supplies are things we're going to use in the future. So when we purchase the asset, we debit that, and we would have been crediting cash. But then the way it's a little bit different is at the end of the period, what you usually do is you count up the supplies and see how much you used during the period. That happens here where I work. If I need sticky notes, I go over to the supply people and I say I need sticky notes and pens, and they write up a little ticket. And at the end of the month, what they do is figure out how much we've used up, and then we do an adjusting entry, a debit to the supply expense and a credit to the asset supplies. And then we have a new balance of supplies that are remaining or available to be used. So that entry, once we figure out how much we've used up, is going to look like this: a debit to the expense and a credit to the asset. So again, these prepaid or deferred expenses always look, the adjusting entry always looks the same: a debit to the expense, a credit to the asset each time. One more version of this that's a little different is called depreciation. We'll learn more about it in depth in the future. But the idea of depreciation is that certain assets, like long-lived assets, or they call them plant assets in accounting, like equipment, buildings, cars, etc., they have a useful life that lasts longer than a single accounting period. And so what we do is we calculate how much of the cost of that asset we're going to claim as an expense over each period of the asset's life. And the way we do that is by taking the cost of the asset, dividing it by subtracting any salvage value, which means any value we think the asset will have at the end of its useful life, and then we divide it by the time in its useful life. So here's an example. They purchase equipment for $26,000. It has an estimated useful life of 5 years, and it's expected to be worth about $8,000 at the end of the 5 years. So what we're going to do is we're going to calculate how much expense we're going to record each year during this asset's life. Again, if we take the full $26,000 as an expense up front, that doesn't really accurately portray the fact that we're getting benefit out of this equipment for 5 years. So instead, we want to spread that expense out over the asset's life. So then we take the original cost minus the salvage value. They call it net cost in this McGraw-Hill book. A lot of times it's called the depreciable value, the amount you're going to depreciate. And then we take that depreciable or net cost and divide it by the number of months in the asset's life. It was 18,000 divided by 60, means we're going to depreciate or claim as an expense $300 of the cost of that asset each month. So we create an entry that debits depreciation expense and credits the accumulated depreciation account. So this is different than the first two examples I gave, because with depreciation, with long-lived or plant assets, we like to leave the asset showing its cost, and then show the cost of the asset being used or depreciated over time in a special account called accumulated depreciation. The accumulated depreciation account is a special account that's linked to the actual asset account, and it's what's called a contra asset. That's an asset that has a normal balance on the credit side, the opposite side that an asset normally would. And when we're figuring out, well, what's the value of the asset, they call it the book value of the asset. It would be the asset's cost, so like this 26,000, less any accumulated depreciation on the asset. So the adjusting entry each period is going to be to debit the expense account, depreciation expense, and instead of crediting the asset account directly, we're going to credit the accumulated depreciation account that is linked to that asset. That's the way it's done with depreciation. On our balance sheet, it will look something like this. It'll show equipment, less any accumulated depreciation, and then it gives you this value. And that, again, that value, the cost of the asset minus any depreciation is referred to as the book value of the asset. And be careful we don't confuse book value, cost less accumulated depreciation, with market value. I mean, it's possible that that equipment could have gone up in value because it's really valuable now and people want it or something. And so this just represents our cost minus any amount we've depreciated. It doesn't necessarily represent what the market value of that asset would be at any given time. All right, so that was a deferred expense. I showed you 3 examples of it. The first was a prepaid assets. The second was supplies. And then the third was depreciation. So now we'll move into a deferral of revenue. So with a deferral of revenue, what happens is someone pays us money in advance, but we haven't earned it yet. And we don't record revenue until we've actually earned it. So again, when that first happens, what we do is we would be debiting our cash because our cash is going up, but then we'd be like, what do we do with the cash? Because we haven't earned it. So what we do is we create a liability account, a special liability account called unearned revenue, which represents money received in advance of it being earned. Okay, so the initial entry would be to debit cash and credit the liability unearned revenue. Then as we start to earn that revenue by actually providing services to the customer, we have to do an adjusting entry. And in that adjustment, we're going to debit the liability to decrease it, and we're going to credit revenue to show that we've actually earned it. So that's the process going on there. So here's an example. Fast Forward's client paid a 60-day fee in advance, covering the period from December 27th to February 24th. So Fast Forward earns payment as time passes, and at 12/31, they've earned 5 days worth, which is $3,000. Oh, no, sorry, which was $250. So step 3 was the adjusting entry to reduce the liability. So let's just show the example of what it looks like. So when we get the money, our cash goes up and our liability unearned revenue goes up. Then when we get to the end of the month and say, hey, we've earned a certain amount of that money, we do an adjusting entry to debit unearned revenue, so decrease the liability, and credit the revenue account. Too much animation. All right. So the adjusting entry will look like this: debit unearned consulting revenue and credit consulting revenue. What can be hard about these sometimes is it will just tell you, hey, they got $3,000 and it represents 60 days, and then that's all it will tell you. And then, so you have to figure out, oh, okay, so from the time this contract started to the end of December was 5 days. So I've got to take the full amount, divide it by 60 to get a daily amount, and then multiply that out by 5, right? That's kind of the process they went through. They didn't explain very well to figure out how much that adjusting entry will be. That's sometimes the hardest part of these is like sometimes they're just telling you, oh, this is the amount of the adjustment, and other times they're leaving you to have to calculate it or figure it out. So you have to read them very carefully. So the third type of adjusting entry is called an accrued expense. So accrued expenses happen when we actually incur the expense, but we have not yet paid it. So this happens a lot as we use services. Probably the most common example is our employees working for us. So they'll work each day, they'll punch in on the time clock, or they'll have salaries, and they'll be and so the wages that they're earning are an expense to us, but we don't typically record those wages until the next payday. But when we get to the end of the month, we would have to recognize we have some wage expense sitting out there that we need to record as an expense, but we won't actually pay it until the next payday. This is especially true, say, companies that pay people on, every other Friday or something like that. They'll have employees that have earned money, and therefore we owe the money to them, and it's an expense that we've incurred, but we haven't yet recorded it. So that's probably the most common example of how that happens. So what we do is we get to that end of the month, we tally up the money we owe and that we've incurred an expense on, and we debit the expense account and we credit the liability account, saying, something payable, usually salaries and wages payable. So here's an example. Fast Forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. On December 31st, or December 31st is a Wednesday. So there's 3 days salaries are owed at the year end. But we're not going to pay them until next Friday's, at the payday. Okay. So we recognize that. We recognize our employees have worked, we owe these salaries, and we've incurred the expense of them, and we need that expense to show up on our income statement so it's accurate. So, so the process is to take the daily rate, multiply it by the number of days, which is $210, and then create this adjusting entry. We debit salaries expense, and we credit salaries payable. So the adjusting entry for accrued expenses is always the same. It's a debit to the expense and a credit to a liability account. It's a liability because we owe it, but we're not going to pay it till the next payday or whatever other circumstances we'll be paying. So that'll give us a balance in our salaries payable. We'll be able to show our salary expense for the period so that our income statement will be correct. And then we have to recognize that at some future point, we'll actually have to pay the cash, right? That's that we created a payable for. So the accrued salaries of $210 on 12/31, then January 9th of the next year, we'll have to actually pay those salaries, in addition to the salaries everybody's earned from January 1st up to January 9th. So it's going to look like this. When we actually go ahead and pay those salaries, we'll debit salaries payable, that liability account we created at the end of the month when we did the adjusting entry. And then we'll also debit the salaries expense for the money our employees earned from January 1st up until payday. And then we'll credit cash because we're actually paying out the cash. So you have to sort of, in the first two, the deferrals, the cash happened first, and then we had to make adjustments for how much of the expense we'd incurred or revenue we'd earned at the end of the month. In these second two, the accruals, now the expense or revenue occurs first, and then later we have to do this entry to show when the cash actually moves. And so in this case, we're paying cash. When we do the accrued revenue, we'll be receiving cash in the future. So the final type is what's called an accrued revenue. And again, this happens most often in businesses that do sort of like billable work, accountants' offices, attorneys, who do work for clients throughout the month. And then at the end of the month, they kind of tally up the amount of work they did and they bill the client. So they recognize we've earned this revenue during the month, and so we need it to be recorded on our books so that our income statement will be correct. But we're not going to receive this revenue and probably until the next period, the next month. So at the end of the month, we do this adjusting entry where we debit the asset, and the asset will usually be called accounts receivable, and we credit the revenue, the money we've earned but have not yet received. That's what the adjusting entry looks like for an accrued revenue transaction. So here's an example. Fast Forward's customer agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. On December 31st, we recognized that we had earned 20 days worth of that revenue. So that comes out to $1,800. So at the end of the month, we do an adjusting entry to recognize the revenue we've earned and to recognize the accounts receivable, the money that will be owed to us when it's time to pay. So we debit accounts receivable, that's increasing an asset, and we credit the revenue account, which is increasing the revenue. And so that's going to allow us at the end of the year to have accurate revenue for our income statement, and then also have that accounts receivable showing that money is still owed to us. In the future, when the customer pays us, we're going to show the total cash of $2,700 that we got from the customer. $1,800 of it is in the form of accounts receivable. That's the money we earned in the previous financial period that we're now getting paid. And then the other $900 is for any revenue we've earned during this period, this year. Okay. All right. That was a lot, but there's still a couple more things. Sorry. So the first is, how do we prepare financial statements from an adjusted trial balance? So after we do all of those adjustments, we take our unadjusted trial balance, which we would have had, and then we calculate the new balance of all the accounts with those adjustments in it, and that creates what's called an adjusted trial balance. That's right here on the upper right. What's nice about a trial balance is if this were old school and you were having to create financial statements, the trial balance gives you all the info you need to do that. It has the assets, the liabilities, the stockholders' equity, the revenue and expense accounts, and the dividend account all summarized in a single document. So the first thing we're going to do is prepare the income statement. That's our revenues minus our expenses, and that's going to give us our net income. Once we have our net income, we can prepare our statement of retained earnings, which is our retained earnings at the beginning of the financial period, plus any net income, minus any dividends, which gives us the retained earnings at the end of the financial period. And so we can see this business was brand new, so there was 0 retained earnings at the beginning. We add the net income, which we calculated up here on the income statement. We subtract the dividends, which we can see up here on the trial balance. And that leaves us with the retained earnings at the end of the financial period. Remember, retained earnings is just any net income or profit a business makes that it doesn't pay out to the owners as dividends. And we tend to retain those earnings so that we can invest them in future periods of time. Once we have our statement of retained earnings, we can create our balance sheet, which summarizes our assets, again, pulled right off of the trial balance, our liabilities, which are our debts, again, pulled right off of the trial balance, and our equity, our common stock, which represents money put in by the owners, and then our retained earnings, which we calculated over here on the statement of retained earnings. Of course, with the balance sheet, those things all have to add up. Assets have to equal liabilities plus equity. So it's actually really nice that a trial balance gives you all the info you need to just do that work. And I kind of like how this diagram lays it out. It's a nice little diagram. All right, so the last thing is closing entries. So we have to recognize that there are some accounts that we consider permanent and some accounts we consider temporary. And by temporary, what we mean is these are accounts that we are going to need to reset to 0 each month or each accounting period. The reason is because we measure revenue and expenses and dividends across the period. How much revenue did we make from January 1st to January 31st? How much expenses did we incur from January 1st to January 31st? Whereas things like assets, we don't measure across a period of time. We would say, well, how much is, how much assets do we have as of this day, January 31st? How much liabilities do we have as of this day? So these accounts that have to be reset to 0 because they measure the change or growth in something over time are called temporary accounts. And they are the revenue accounts, the expense accounts, the dividend accounts, and then this special account called income summary that we create really only for the process of doing these closing entries. And our goal when we close is to summarize all of these accounts into a single amount and then post them to a permanent account. That account is retained earnings. So here's the process. First, we close the income statement credit balance accounts, which really means we close the revenue accounts. Second, we close the expense accounts to income summary. Third, we close the income summary account to retained earnings. And then finally, we close our dividends directly to retained earnings. So that's the process. 4 steps, 4 joyful steps to closed accounts, right? So here's what it looks like. Each of our revenue accounts at the end of the financial period will have a credit balance. Why? Because that's the normal balance for revenue accounts. It's either going to have a 0 balance or a credit balance. Okay. Each of our expense accounts will have debit balances. Why? Because that's the normal balance for an expense account. So we start by closing the revenue accounts. And all we do is we say, okay, this has a credit balance of $7,850. And so to close it, all we'll do is debit that account $7,850. That will leave the account with a balance of 0. But I can't just debit. I can't just do a debit without a credit somewhere. So my closing entry will be to debit consulting revenue, $7,850, and credit income summary, that same amount. Likewise, rental revenue, which had a credit balance of $300, I will debit $300, and I'll credit income summary. So now I've credited income summary $8,150 and debited these revenue accounts so they have balances of 0. I've successfully closed them out. They're reset to 0, ready for a new month. My expense accounts all have debit balances. So I will credit each of those accounts an amount equal to their balance, which will bring their balance to 0. And then I will debit the income summary account. Now I've successfully closed my expense accounts, and income summary has a balance in it. If it has a credit balance, it means I had more revenue than I had expenses. If it has a debit balance, it means I had more expenses than I had revenue. So in this case, we have a credit balance. If you think about it, that represents net income because it's our revenue and our expenses. So then I'm going to close out that balance and income summary. So if it had, in this case, it has a credit of $37.85, I'll do a closing entry, debit of $37.85 to income summary, and a credit to retained earnings. Remember, retained earnings is an equity account. So crediting it is increasing it. So in this case, where I had more revenue than I had expenses, I ended up with a credit balance and income summary, and then closed it by debiting income summary and crediting retained earnings, thereby increasing retained earnings. If you think about it, it's me taking my profits, my net income, and passing them into the permanent account retained earnings. The last thing I do is I look at my dividends account. It will always have a debit balance. So I'll credit dividends, and then I will debit retained earnings, which effectively reduces retained earnings, because dividends is really just paying out of money to the owners. And so in the end, retained earnings goes up by our net income, down by our dividends, and there's our new balance in retained earnings. That's the closing account. Once I do all that, revenue, expense, income summary, and dividends are all back to 0, ready for a new month of keeping track of our business transactions.